Imagine owning your dream home with monthly payments that finally feel affordable. Sounds perfect, right? Now imagine that same home, but you'll still be paying for it when you're 75. That's the reality behind the idea of the 50-year mortgage, a proposal that's getting attention for all the wrong reasons. Today, we'll unpack what this really means for home buyers and investors, and why stretching a loan to half a century might sound smart, but ends up costing far more than you think. Welcome to Invest Education Hub, where we turn complex money topics into clear, practical lessons that help you invest and borrow smarter.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
All right, let's get right into it. The whole idea of a 50-year mortgage, well, it's not exactly new. It tends to pop up whenever the economy gets a little shaky, and honestly, you can see why. Right now, we're kind of in this perfect storm for anyone trying to buy a house. Home prices are still sky high in a lot of places, and on top of that, interest rates have shot up. It's a classic squeeze play on buyers. So when someone comes along and dangles a product that promises to lower that monthly payment, of course people are going to pay attention. It's sold as this great key to affordability, a way to unlock the door to homeownership for people who feel completely priced out.
And that's really the hook, isn't it? I mean, who wouldn't want a lower monthly payment? Let's be real. You've probably done it. You've gone on a mortgage calculator, you've punched in the numbers for a house you love, and your heart just sinks when you see that monthly figure. It feels just out of reach. So the idea of just stretching the loan out, making that number a little smaller, a little more manageable, it's incredibly appealing. It feels like you found a secret loophole, a way to get the home you want now, instead of waiting who knows how many years. But as we're about to find out, that little bit of monthly relief comes at a ridiculously high price down the road.
Okay, so let's pull back the curtain and actually look at the math, because this is the exact moment where that pretty picture starts to fall apart, and fast. You see, true affordability isn't just about the number you can squeeze out of your budget each month. It's about the total, all-in cost of what you're buying over its entire life. So we're going to put the good old 30-year mortgage, the absolute standard for homeownership in America, right up against this 50-year idea. And we're going to see what those extra 20 years of payments really get you, and more importantly, what they take from you.
So take a look at these numbers with me. Let's imagine a $400,000 loan, which is pretty standard these days, at a 6.5% interest rate. Now, with a normal 30-year mortgage, your payment for principal and interest is going to be about $2,500 a month, $2,528 to be exact. Okay, now let's stretch that same loan out to 50 years. Your payment drops down to about $2,290, so you're saving about $238 a month. At first glance, you might think, hey, that's not bad. But, and this is a huge but, look at those other columns. On the 30-year loan, you pay a crazy $510,000 in interest over the life of the loan. But with the 50-year loan, hold on to your seat. You pay almost $1 million, $974,000 just in interest. The total cost of that $400,000 house goes from around $910,000 to nearly $1.4 million. It's just staggering.
Let's just pause on that for a second. $460,000. That isn't a typo. That is the extra interest you pay, just for the benefit of saving a couple $100 a month. To really put that into perspective for you, $460,000 is more than the median price of an entire house in the United States. You are literally paying for a whole second home just in extra interest payments. And for what? For a monthly savings that probably wouldn't even cover your family's cell phone bill? This isn't affordability. This is a financial sinkhole with a welcome mat in front of it.
And this right here shows us why the math just doesn't work out. It's a concept called diminishing returns. See, when you're extending a loan, the biggest bang for your buck happens early on. Going from a 15-year to a 30-year mortgage, for example, that can boost a buyer's purchasing power by over 30%. That's a huge leap, and it's why almost everybody goes for the 30-year. But that jump from 30 years to 50 years, the benefit just falls off a cliff. You're gaining less than an 8% increase in so-called affordability, but you're tacking on 20 additional years of debt. The trade-off is just terrible.
So you might be wondering, why does it cost so much more? Well, it all comes down to a really important idea called front-loaded interest. Every fixed-rate loan works this way. In the beginning of your loan, when your balance is the highest, the bank makes sure it gets its profit first. So the lion's share of your monthly payment goes directly to them as interest. Only a tiny, tiny fraction of your payment actually goes to reducing the amount you borrowed in the first place. That's your principal.
This chart just lays it all out plain as day. Look at what your first payments are made of. That giant bar, that's the interest you're paying. And that little sliver next to it, that's the principal. That's the part that actually builds your ownership, your equity in the home. On a 30-year loan, it already takes years and years before your principal payment is bigger than your interest payment. Now imagine a 50-year loan. You're stretching out that interest-heavy period for decades longer. It absolutely cripples your ability to build any meaningful wealth in your own home for a very, very long time.
So, okay, we've gone through the math, but let's talk about what this actually feels like, what it means in the real world. Because this isn't just some spreadsheet exercise. This kind of loan has a really deep and frankly dangerous impact on a homeowner's financial well-being, their ability to build wealth, and just how much risk they're taking on. In this case, time is definitely not your friend.
Think about this for a second. The average person stays in their home for about 12 years before they sell and move. Now, let's say you had a 50-year loan on a $550,000 house. After 12 full years of making that payment month in and month out, you would have paid off a grand total of $32,000. That's it. In those 12 years, you would have sent over $400,000 to the bank, but less than 8% of that money actually went toward you owning your home. All the rest, pure interest. You've barely scratched the surface of what you owe.
I mean, that quote just hits you, right? It perfectly captures what this feels like. It creates this sensation that you're just a long-term renter in a house you're supposed to own. You're the one making the payments, you're fixing the leaky faucet, you're paying the property taxes, but that actual ownership stake, the equity that gives you financial freedom, it builds at a snail's pace. For decades, the bank holds all the cards and gets almost all the financial reward.
And here's where things get really, really dangerous. That slow equity growth makes you incredibly vulnerable. We think of homeownership as a path to stability, but this kind of product does the opposite. It dials up your risk. If the housing market cools off, if prices dip even a little bit, you could very easily find yourself underwater. That means you owe more on your mortgage than your house is actually worth, and that traps you. You can't sell it without writing a massive check at closing. You can't refinance it. It's a terrifying financial corner to be backed into.
So when you boil it all down, this is what you're left with. The promise, the sales pitch, is that this is a tool for affordability. It's a helping hand to get you into a home. But the reality? It's a contract for lifelong interest. It's a financial product designed to benefit the lender way more than the borrower, by maximizing the amount of interest they can suck out of you over an enormous time frame. It's not a solution, it's a trap.
And all of this brings us to a much bigger, more important question. Is messing around with loan terms like this really the answer to the housing crisis? Or is it just a distraction? You know, a bit of financial magic that looks like a solution, but actually ignores the real, fundamental problems we're facing.
Because here's the hard truth. The root of the housing affordability crisis isn't that loans are too short. It's a basic supply and demand problem. There just aren't enough homes out there for the number of people who want to buy them, especially in that starter home price range. Stretching out debt doesn't build a single new house. In fact, you could argue it makes the problem worse. By letting more people technically qualify for higher-priced homes, you just increase demand without increasing supply. That can push prices up even more for everybody.
So if this isn't the answer, what is? Well, thankfully, there's some really smart, practical ideas out there that tackle the actual problem. For one, increasing the capital gains exclusion on home sales. Think about it. That would encourage a ton of older folks who've been in their homes for decades to sell without a huge tax hit, which would unlock so much inventory. Another great idea is mortgage portability. That means you could take your amazing 3% mortgage rate with you to your next house. That would unstick so many people who feel trapped right now. And, of course, the biggest one. We need policies that actually incentivize building more homes and getting rid of outdated zoning rules. These are real solutions that fix the system itself, not just the payment plan.
So at the end of the day, it really comes down to this one simple question. What is your goal? Is it to truly own an asset, to build real wealth and security for yourself and your family? Or is it to just rent money from the bank for pretty much your entire life? Because a 50-year mortgage fundamentally changes the game from one of ownership to one of perpetual debt. The 50-year mortgage might sound like innovation, but it's really inflation on your future. Real wealth comes from owning assets, not endless liabilities. If this explainer helped you see how long-term debt can quietly hold you back, hit like, subscribe, and share it with someone who's considering buying a home. Here at Invest Education Hub, we help you build wealth through clarity, not confusion, because smart investing starts with understanding the real cost of money.